Welcome everybody. Thank you for tuning into this video. So today we're going to be discussing note investing and what that looks like. We're going to talk about the economy, what's going on in the stock market. We've got a lot of cool things we're going to cover today. This isn't going to take a really long time, so stick with me and we'll get through this and we'll provide you with some cool information and go forward from there. So let's get right into this presentation. As an introduction, hi, my name is Wayne Garrett. I am the founder of NoteFellow. I've been a note investor for a few years, and I think note investing is fantastic. I've looked at it compared to several other ways of investing in real estate, and it has quickly become my favorite go-to way to build wealth for my family. And as we go through this presentation, I'll continue to show you how this process works and why I think it's a superior way of investing when it comes to real estate and a great alternate way to add to your additional uh, investments, to add to your portfolio, and a way to just build wealth for your family over the future. So let's get into this presentation. So the first thing I want to point out is that there is no such thing as a safe investment, according to the SEC. Again, this is NoteFellow. My name is Wayne Garrett, and I am not providing any type of tax information. And it'd probably be helpful if we move me out of the way. So let's do that. So I'm not providing specific tax, legal, financial, or investment advice. Nor is NoteFellow endorsing any products, services, or investments of any type from anyone in attendance. Always check with your advisors before making any investments. So let's talk about some questions to ask yourself before we begin. What are your current investments? What does that look like? What are you currently invested in? Is it stocks? Is it rental properties? Is it something else? What is the length of my longest investment? What are the current what is the current return that I am receiving on my investments? So let's talk about what note investing is. The easiest terms is the goal is to become the bank. Well, what is a note? Let's look and define a note. So a dollar bill, or in this case, $100 bill from the Federal Reserve, that is a note, right? It's a Federal Reserve note. A check, that's a different type of note, but it's still a note. What about when you buy a car? Most people that buy cars, they finance them and they sign a promissory note agreeing to pay the car. But the one we're here today for is the mortgage note. And that's what we're going to focus on today. So let's look at this scenario. This is a pretty straightforward scenario that we're all familiar with, where we're going to go through a couple of examples just to make sure we're all up to speed on the same page. So in this situation, we have a house, we have a buyer, and we have a seller. And of course, we have the bank. So let's look at how this exchange may play out. So the seller has an ownership deed. He's going to transfer that seller or that ownership deed to his house buyer. Now, his house buyer is going to sign a mortgage note. That mortgage note is going to the bank, and the bank will fund the transaction. And the house acts as the collateral, guaranteeing the bank will get their money. Now, in this situation, we made a little modification. What if the seller becomes the bank? This is called seller financing. Some people may know it as owner financing. In this case, the seller has the mortgage note and the seller receives the payments with collateral that he is already familiar with. That's a cool thing. I like this. So let's look at a mortgage note. What really makes up a mortgage note? You have the terms of the agreement. You have the principal that's paid at a certain interest rate, which gives you monthly payments over a certain amount of years, say 30 years. You have a buyer that then signs the mortgage note, agreeing to all the terms that we just listed out. So let's look at a quick video. I want to show you guys a quick video on notes versus rentals, because I know a lot of people are into rental property and they like rental property, and I think rental property has its places, but I think that note investing is a far superior way of building wealth over time. And I think it really gets you the cash flow that you're really looking for when you get into investing in rental houses. So let's check out this video.
Welcome to the Notes versus Alternative Investment series. In this video, we'll be taking a note and putting it up against a rental and comparing the differences between the two and see which one keeps more money in your pocket every month and which has less risk. The first thing we need to highlight is the fact that notes are the financial or paper side of the real estate business. And the stick and brick house is going to be the collateral we can take back if something should happen in a worst-case scenario and the note is not repaid. Keep in mind, however, that thanks to the flexibility of note investing, often these worst-case scenarios turn out to be our best investment friends. When we're comparing investments, we want to keep our analysis fair on both sides to get the most accurate comparison between the two. The first thing you'll want to notice is the market value is $120,000 for both the note and the rental property. Notes have a big advantage because they come without the headaches of toilets, tenants, or turnover that come along with rentals because it's the responsibility of the owner to take care of those things. When there is an issue, let's say a backed up sewer line, for example, the note holder doesn't get billed for anything. And this is a common problem with rentals because the owner must pay for repairs. And that dips into the profits. Not to mention the nuisance of having to find a new tenant when the previous one moves out in the middle of the night. Now, let's compare the income streams and see which asset actually keeps the most money in your pocket. To keep the comparison as close to factual as possible, we're going to have both assets bring in about $1,000 a month. The rental property has a property management firm that averages about 10% of the monthly income. So that's $100 a month taken out. Now, you'll want to have the note serviced by a third party, which typically is at most $50 a month. Let's look a little further and see what expenses take a chunk out of the monthly payment of these assets. Now, a good rental investor will allow for vacancies of at least $50 a month. And you'll also have to include property taxes of at least another $100. And insurance will be needed with an OK policy at around $50 a month. There's also a maintenance reserve of around $100 a month that you should be setting aside for fixes that will inevitably occur. Here's an insider's tip. Most good investors will keep 10 to 20% of the monthly rent toward maintenance, but we'll stay conservative at 10. So once you add all these conservative expenses together, the total profit on the rental side is only going to be $600 at best. But our note is staying strong and avoids most of these expenses because all the expenses we just mentioned are the responsibility of the homeowner, and it's their job to pay for those expenses. So the note holder still gets to keep their $950 a month in profit. And that's over 50% more profit per month than rentals. Not to mention the absence of all the headaches that come along with rental ownership. Notes just don't have big expenses like rentals do. And that's just one of the biggest advantages notes have over rentals. And at the end of the day, remember, we're the bank. And people don't call the bank when something goes wrong. Also, one of the biggest secrets to building true wealth is keeping what you've earned. We hope you enjoyed this video, and we'll see you next time. Thanks for watching.
So there you have it, rentals versus notes. And as you saw in the video, the great thing I love about notes is you don't have tenants and toilets, you don't have all the maintenance fees and all the additional unexpected expenses that you have with a rental property. I think that makes notes a really powerful way to build your wealth and to really get that cash flow that, let's be honest, that's what you're seeking. When you're buying a rental property, are you buying a rental property to buy a job, or are you buying a rental property for cash flow? I know for me, if I'm going to invest $100,000 into something, I would rather have the cash flow. And notes is just a really powerful way of doing that. And there's so many different options. As we go and I create more videos, I'm going to show you guys different techniques and ways that you can borrow money against notes, that you can slice notes up and do different things with them. So going forward, I'm going to put out some additional videos that go into some of these things and really give you guys a good idea of why I like note investing so much. So let's continue with our presentation. The stock market. Have you ever felt like this from the stock market? There's a lot of twists and turns in the stock market. Over the last 15 to 20 years, maybe your retirement account has felt like this roller coaster, right? In 2008, the market lost 37%, which made a lot of people have to re enter the workforce. My in laws had this happen to them as well. What about 2020? Well, the stock market lost 28%. This year, I've got a chart that shows this year too. So we'll get into that in a minute. The first thing I want to point out is doing research. I want to look at some interesting charts and see how they apply to you. So the first thing I want to talk about is seller financing and just how popular seller financing is. So you see that in 2013, 2014, it had really peaked. And these seller financing is really used as different markets condition changes. Interest rates go up, especially when interest rates go up, or banking tightens their guidelines on who they loan to. So all of a sudden, someone that could get a mortgage yesterday can't get a mortgage today. How else are they supposed to buy a house? Are they just supposed to give up and be stuck renting all their lives? No, it doesn't have to be that way. All they have to do is find someone willing to seller finance their house, and there's an opportunity. It creates an opportunity for someone for home ownership, and it also creates an opportunity for that person originating that note, doing the seller financing, to gain cash flow and a payment stream over several years. Money in the bank. So in fall of 2021, there was $16.5 trillion in the bank. Just people sitting on dry cash because the markets are crazy, COVID was still going. People were just unsure of what was going to happen. When people are unsure, they park their money on the side. But what are we seeing today? We're seeing all sort of market conditions changing. We see the dollar being devalued. So all of a sudden, leaving your money sitting in a bank account may not be the best thing for your money to do. As the money continues to be worth less, you're not getting any money or any real interest from the bank. In fact, you're paying oftentimes a $15 fee to the bank every month just for the honor of having a checking account with them. So remember, I want to point something out. The goal for this is to be like the bank, not to be exactly like the bank. We want to take the good things that the bank does and the strategies that they use to make money and implement some of those where we can. The checking account charges, not so much. So how does this apply to you? Well, let's look at the stock market. So the stock market's fall has wiped out $3 trillion in retirement savings this year. This is a Money Watch report from this year, June 17th. So this is current. $3 trillion. in retirement savings. And that's the worst thing that happens is when your retirement goes down, it does not recover very quickly. What if you're someone you're in your mid to late 50s and you're really wanting to retire when you're maybe 63, 64? This may delay your plans. You may end up having to work another 5 years to try to regain some of that value you had in your retirement. What are we really looking for when we invest? We want something that's steady and consistent, right? You want to know that what your money is doing while you're working, spending time with family, or vacationing. For instance, if you took $25,000 and you were able to get 10% interest for 20 years, that's 230 months, you would get a payment of $241 every month for 20 years. And that's just off one note. So, how does note investing differ? You get paid once a month, like we said, and that includes a principal and interest. Remember, you're the bank. You don't have to check every day to see what your money is doing. Your return is fixed. Oftentimes, you see people that are invested in the stock market, they're always worried. They're always looking, what's the stock market doing? Am I up today or am I down? Am I gaining money or am I losing money? With note investing, your money is steady. You get a check that hits the mailbox every month. And the more notes you add to your portfolio, the bigger that check grows. So where do you start as a note investor? Well, the first thing to start with is working with someone that you know, like, and trust. And that's really the purpose of me doing these videos and these series of videos. I try to put out a video at least once a month. And it's to allow you to get to know who I am, to know who Notefellow is, that we exist, and that we're here for you to help you meet your goals. We want you to, it's of the utmost importance that you know who we are, like I said, you like what you're investing in, and that you trust who you're dealing with. And the only way I can build an initial rapport with you is doing these live videos so that you can watch them. Even if you're not on the live stream now, hopefully you're catching this on a replay and this speaks to you. And you may be thinking, well, what if they stop paying the note? Because that does happen, right? That's a reality. People sometimes don't pay. Well, let's look at an example. So if you have a home that's valued at $65,500, I don't know what home this day would be that. I may have to update some of these numbers a little, but just for conversation. And you invested $36,144 for first lien on the property. You have equity. There's margin in the deal for you to be able to do something. You can either restructure the debt to a willing and able buyer. People sometimes go through legitimate hardships. Sometimes people go through medical hardships. Sometimes people lose a job and it takes them a month or two to find a job again and start being able to repay. And I've had these scenarios happen. I've had people get behind a couple of months because they lost a job because of COVID. They found a new job and they worked over the next few months to catch themselves up, and they got caught up and current again. And I'm willing to work with people. And then there is a foreclosure process. If you happen to come across someone, you end up with someone that just says, for whatever reason, I'm not paying anymore. There are foreclosure processes to be able to get them out and reclaim the house and sell it and get the money that's owed to you. Because remember, just like the bank, when the bank forecloses on a house, they do that in order to be able to sell that house and get their money back out. And the whole trick to it is making sure that you buy right. When you buy a note, you make sure that you have enough room or a good LTV, a good loan to value, meaning the amount that you've paid for the loan is, let's say 70% of what the value of the house is, so that you've got some wiggle room in there. So what type of investor do you want to be? Do you want to be active or do you want to be passive? Now, the active investor, let's look at all the things you have to do as an active investor in this business. So you have to source the notes. That's what I do. I'm an active investor, by the way. Review all the collateral files, verify the valuation on the collateral, the due diligence, working with attorneys, code enforcement, dealing with servicers, etc. You have to fund the deal, and then you have to receive the payments. So there's a lot more steps involved. If you're passive, what I do for passive investors, it's a one-time review of the collateral to make sure, hey, is this something I like? Is it a neighborhood that I like? Things I review with my investors. Select the collateral, review the file with me so that you have a good understanding of, hey, here's all the documents that are there. You're good to go on that. Fund the deal and then receive the payments. Because what I offer is I walk you through this process. Even though you're a passive investor, I'm not going to say, well, here you go, good luck. This is more of you're providing the funds and I'm hooking you up with the collateral or the note, and we're investing your money. That's really what this is. So what about due diligence? So some of the due diligence I was talking about, you have valuation, you have the market conditions, demographics, things like how many married couples live in the area, what's the blue collar versus white collar job ratio, what's the average annual income, what is the crime rate. So you don't necessarily want to buy a house in a high crime rate area. You're probably going to have problems, and you're probably going to end up with a borrower who ends up not paying. What's the school rating? People want their kids to go to decent schools, so school rating has some importance. Industry. What kind of jobs are there in the town? Are there jobs available in that town or in that city that someone can gainfully find employment so that they can keep making their payments? These are all things that I have to consider when I'm looking at a note purchase. And an easy way to fund this, or a good way to fund it, is getting self-directed. This is something I learned about a few years ago that's really been great. There's invest in tax deferred or tax free. You have traditional IRAs. You have Roth IRAs. You have solo 401ks. You have simplified employment pension plans, health savings accounts, educational savings accounts, and plenty more. The bottom line is you can fund these out of your pocket, out of your bank account, or you can use a self-directed retirement account and use the note investing to build your wealth for the future. The wealth you really intended when you put money in your company's 401k plan. So again, I just finished with this. If you would like to contact us, here's my website. If you go to my website at www.notefellow.com, there's an orange panel you see in the center of the screen. I've circled it in green. Click on this button and schedule a call with me. Puts it on my calendar. We can do a call and we can talk about what kind of investments and opportunities might be right for you. If you don't want to schedule a call just yet, reach out to me via email. I have my email address at wayne@notefellow.com. Send me an email and ask me for some more information. I'd be happy to share any type of information that I can, and let's just kind of have a conversation and start down the path and figure out maybe what in note investing is going to work for you. What aspects of it may fit into your investment model. So again, thank you for spending some time with me today, and I look forward to speaking with you in the future. Thank you.